All right. Today, we're going to dive into two completely different financial worlds that somehow exist in the very same country. It's fascinating, really. On one side, you have certain states acting like giant magnets for money, using some really clever policies to attract wealth. And on the other side, well, you've got the national story, a story of ever-growing, staggering debt. So let's start with a question to frame this whole thing. What if the way you manage your money, saving, investing, trying to be responsible, was the complete opposite of how your country was managing its finances? It's a weird thought, right? While you're trying to build wealth, the national system is pretty much built on borrowing. Let's dig into how that actually works. Okay, first, let's zoom all the way in. We're gonna look at the state level, the sort of microcosm of how a place can create this powerful magnetic pull for both money and people. The first and maybe the biggest tool in the toolbox is getting rid of the state income tax. This is just a foundational policy. It means the money you earn from your job, from a business, even from renting out a property, none of it gets taxed at the state level. It's simple, really. You just get to keep more of your own money. And that is a huge incentive for people and businesses to pack up and move. Next up, there's a pretty sweet benefit for homeowners called the Homestead Exemption. This thing is designed specifically to lower your cost of living. Basically, it's a property tax break that cuts down the taxable value of your main home, which means your annual tax bill gets smaller. Simple as that. And the impact here is immediate and really obvious. Without this exemption, you're paying taxes on the full value of your home. But with it, a big chunk, we're talking up to $50,000 in some places, is just shaved right off the top before they even calculate the tax. That adds up to real savings, year after year after year. But here's the one that a lot of people don't know about. And honestly, it might be the most powerful benefit of all. It's a cap on how much your property's taxable value can go up each year. It's usually limited to just 3% or the rate of inflation. And get this, whichever one is lower. This is what protects homeowners from getting slammed with massive tax hikes when the real estate market gets hot. So let's see how this plays out. Imagine your home is valued at $500,000. The market goes absolutely crazy, and its real value jumps by 10%. Normally, your tax bill would soar too, but with this cap, nope. The value used for your tax bill can only go up by a max of 3%, which in this case is just $15,000. You do that for a few years, and the benefit just compounds into something enormous. So all these state-level strategies are about financial protection, about attracting money, but at the same time, a totally different story is being written at the national level. And now we zoom all the way out to the macro-level story of national debt. And up here, let me tell you, the numbers and the rules of the game are completely different. Just look at that number. That's the US national debt right now, over $36 trillion. It's a number so big, it's almost meaningless. It's almost impossible to actually wrap your head around what that means. So to make it make sense, experts use this analogy. Imagine you earn $50,000 a year, but every single year you spent $70,000. And on top of that, you already had a debt of $360,000. That's pretty much the personal finance version of what's happening on a national scale, spending way more than you make while you're already buried in debt. And look, this isn't exactly a new problem, but the scale of it is just unprecedented. Back in the early 1900s, the debt was around $2 billion. Sure, big events like World War I and World War II caused these huge spikes, but look at the curve leading up to today. It's not a curve anymore, it's practically a vertical line. The growth has become absolutely staggering. So the billion-dollar question, well, the trillion-dollar question really, is why does it keep growing like this? We have to look at the mechanics under the hood of this debt engine. First off, who do we even owe all this money to? Well, it's a really complex mix. A big chunk is held by other countries, like Japan and China. But a massive amount is also held right here at home by the Federal Reserve, by regular people like you and me who own savings bonds, and by things like our pension funds. The debt is just deeply, deeply woven into the entire global financial system. Okay, so where's the money going? The biggest slices of the pie are things you'd expect: Social Security, Medicare, and of course, national defense. But look closely at that chart. One of the single biggest expenses is interest on the debt itself. Think about that. We are borrowing money just to pay the interest on the money we've already borrowed. It's this wild, self-perpetuating cycle. And this, of course, leads to the question that everybody asks. Why can't the government just, create more money to pay it all off? And this is where it gets really counterintuitive. According to financial analysis, new money isn't just printed, it's essentially borrowed into existence. The government issues bonds, the Federal Reserve buys them with new money, but then the government has to pay interest on those bonds. So believe it or not, even printing money is just another form of borrowing that actually adds to the total debt. So all of this leads to what you could call a massive policy paradox. It's a kind of political and economic gridlock where there are just no easy solutions. At the end of the day, policymakers are stuck between a rock and a hard place. They have two main choices. Option 1, raise taxes on everybody, and not just by a little bit. Option 2, drastically cut major, super popular programs that millions of people rely on. As you can imagine, both of those options are politically toxic. They carry so much risk that nobody wants to touch them. So what about that third option? Just printing trillions to solve the problem? Well, history offers a pretty terrifying warning. One of the most famous examples is what happened in Germany back in the 1920s. They tried to print their way out of debt, and it led to catastrophic hyperinflation. The price of bread skyrocketed, and their currency, the mark, became totally worthless. It's a lesson nobody has forgotten. Okay, so let's bring these two totally opposite fiscal worlds together for one final side-by-side comparison. So on one side, you've got the state-level model. The goal there is simple: attract capital and residents. The main tool, reducing the tax burden. And the outcome, a flow of money into the state. Then you have the federal model. The goal here is basically managing a massive systemic debt. The key mechanism is deficit spending, spending more than you take in. And the outcome is, well, more compounded debt. They're just two completely different playbooks. And all of this leaves us with one last really big question to think about. As these two fiscal strategies, one of attraction and one of accumulation, keep moving further and further apart, which one of them is the actual blueprint for the future?